Hi everybody, it's Ryan here, and we're going to be looking at some stuff on aggregate demand, or AD, in today's lesson. First, let's start with the components of aggregate demand. And you can start off by sort of asking yourself, what sorts of goods and services are demanded in an economy? And if you sort of think it through and think who's buying these goods and services, the way that I would break it down, the way that you'll want to break it down in A-level economics, is that there are consumers who are buying things for themselves for their everyday life. There are businesses who are buying things like machines, capital equipment. There's the UK government, which is actively forming a part of the economy, especially since, say, coronavirus. And of course, there's also overseas demand. So we can export our products abroad, and that is one way that we can that we can illustrate that there will be demand in the economy. So aggregate demand. If you review what demand is the quantity of a good or service that consumers are willing and able to purchase at any given price. And so aggregate demand is the total of all demands or expenditures in an economy at any given price level. So what we're doing is we're saying, instead of just for one particular market, which is demand, we're saying of all the expenditures in the economy, put them all together, it's aggregated. That means it's the aggregate demand. So yeah, so like it says, they're basically totaling up all of the demand in the economy. So there's a really important thing to know. There's this function, this equation. We can say that aggregate demand is equal to consumption, household consumption, households purchasing goods and services for themselves. It's equal to investment, which is, as we said, it's businesses buying capital goods for their business purposes. It's government expenditure, and it's also net exports. Now, net exports, well, the reason why we say X minus M is because exports is X, but we're also importing. So we have to sort of account for, if we're taking into account the overall external position of demand in the economy. People demand from us our exports, but also we demand from other people. So if you take one away from the other, then that gives you sort of the net position of our external relationships. So yeah, and these are the definitions for them. So consumption is the spending on consumer goods and services. Investment is the purchase of capital equipment by business. Government spending, the spending in the economy undertaken by the government. And net exports is UK exports minus UK imports. So that's to say, UK exports what we are exporting to the rest of the world. UK imports is what we are buying from the rest of the world. So I find this really interesting, and it's really useful to know that how much does each component of aggregate demand actually take up in the economy. And it's useful to know that household consumption is the largest element of expenditure. In 2018, it accounted for 63% of aggregate demand. I think if we click on this link and go to this research briefing in Parliament, and it will show us that I think recently, if we look through, and here we can see sort of what's happened to the service sector. But and here's household spending. Household spending took a bit of a dip in 2020 due to the pandemic, and you can see that actually as a result of this, where do they have this here? Let's just see if we can find it. Um, oh yeah, I think so. Yeah, these are the percentage changes. Let's see if I can find this. There's one other thing that you can see here. If you look onto the Think Economics website under exercises, and then under 1.2.2 would result in this sort of link to this lesson. It gives us this influence on AD, and let's see if this is any different actually. I thought that this would say what the level of. Oh yeah, here it is. It's not in the graph. House consumption is the largest element of expenditure across the economy, accounting for 58% of the total in 2020. Now, I would expect that going forward in 2021, when they review this in 2022, that this will come back up to, that sort of that higher percentage. It's just because in 2020 the UK government was spending so much money, but I think that's quite interesting anyway. So yeah, and the important thing to be able to do with the components of aggregate demand is to be able to explain what influences them. So the things that influence aggregate demand, let's talk through consumption. Now, what I will do is actually this 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 resource on the website is really good because what it does is it goes through each one of them in turn: consumer expenditure, investment, government spending, and net exports. And these are the sorts of things that you might want to just review to know what does affect consumer expenditure. And these graphs are always up to date. They're embedded from Trading Economics, which is a really good website for just reviewing what's happening with certain indicators. And as you can see, this is what's happened to consumer expenditure, and it's quite interesting to see that look, it's been climbing all along. There's a dip during the Great Recession of 2008, 2009, and it was climbing since then. And then the pandemic has sort of made it go up and down. You know, like lockdown meant that we couldn't spend anything. Then we easy restrictions, and then back down and back up. So that's sort of what's happening. And this summarizes the different the different things that affect consumer expenditure. And we'll just go through each one of those in turn. Consumer expenditure. Now, the first thing to know is just says this is just some facts. What is consumer expenditure as a percentage of GDP for certain countries? I find this really interesting. You can look through, and certain countries have more consumer expenditure as part of their economic makeup than others. The United States has a very high level of consumer expenditure. You know, 67%, even through the pandemic. That reflects the fact that the UK is a consumer society, and they didn't really have very much of a they didn't really have much of a dip in that even through coronavirus. I suppose because they probably didn't have as big, quite it hasn't been measured yet, of government support as say we had in the United Kingdom. United Kingdom is quite high as well, but there's been a little bit of a dip recently, like we just saw there in 2020. They measured that as 60%. This is from the World Bank. India is a bit less. Russian Federation a bit less. Look at a place like China. Now this is interesting. China, they their economy grows through exports or has traditionally. They're becoming more of a consumer-driven economy, and so as you can see, consumer spending is rising in China. Still not at the levels of the United States or the UK, but it is rising now, and that is that is an indication that they're becoming more of a looking towards their internal markets a bit more. The other things that you can say, what affects aggregate demand? Well, GDP growth is going to affect consumer expenditure because GDP growth is, of course, how much income we have, and so therefore the more income we have, well, the more likely we are to want to buy things, and if we don't have income, we're not going to buy them. It's pretty well correlated here. You can see the original graphs up here. It's in the dotted line, and during the Great Recession of 2008, consumption fell, and then it was rising steadily as the economy was growing. And then during the coronavirus pandemic, it fell quite sharply as incomes went down. But then when incomes went up, it went up again. When incomes went down there, it went down again. So quite strong correlation between consumer expenditure and GDP growth. The UK interest rate, in theory, should affect consumer expenditure because the lower the interest rate, this is how it works. The lower the interest rate, the more disposable income consumers will have. Because let's think about what consumers are spending their money on. They're spending their money on probably, a lot of them have a mortgage on their house. And so therefore, if you're paying a mortgage, especially if it's on a variable rate interest rate, what that could mean is that if the interest rates go down, your monthly mortgage payment goes down. And so therefore, you'll have more income that you can just spend on yourself, right? So that's why there should be a correlation between consumer spending and the interest rate. As you can see in the long term, there's sort of two periods here. This is sort of pre financial crisis and post financial crisis. We now live in a low interest rate world, but the idea is that they try to lower the interest rate in order to stimulate that sort of consumer spending, in order to get more money in people's pockets and get them out of the shops and spending it. Let's have a look at this. Now, consumer confidence is another one that you'll want to have a note of to say this is an influence on aggregate demand. If you look at consumer confidence, I don't even understand how it's tracked, to be honest. But there's some sort of tracking level here. I guess it goes on the scale of between 10 and minus 40. When consumer confidence goes down, it correlates with the drop in consumer spending. This is consumer confidence went down in 2008 as a result of the recession. That sort of means that consumption went down. Consumer confidence goes down in sort of the early 20 teens. We've got slowing growth in consumption. Consumer confidence goes down in the result of the pandemic, and consumption falls down. It sort of makes sense, I think, like that. And so there will be some correlation between the growth in consumer spending and their consumer confidence. Now, wealth is an interesting one. Wealth in the UK is measured primarily in house prices, really. I mean, you can look at what it is that the people in Britain own as far as their wealth, but look at this. I think this is good. Home is where the wallet is. Global values of asset classes in trillions of dollars. This is globally. Most people, most of their wealth is actually in their residential property, right? So that's sort of where that's where a lot of people, and so that means residential. That means people's houses and flats and things that that's what they own. It completely outstrips equity. So that's to say stocks and shares, but stocks and shares are a big part. Gold is a big part of your wealth, but as you can see, it's not it doesn't come anywhere near the value of residential property globally. And as property values go up, as we can see they have done in both the UK and the United States in over the past 40 years. So what this is looking at is if you bought a house in 1980, and this is in real prices, by the way. So this is already adjusted for inflation. But if you look at what's happened in real terms, houses in Britain are now, well, an index go from 100 to over 300. That would suggest that they're 217% higher. It's over they've had it's triple what it was in real terms since the 1980s. So I think that's very interesting is to see and to see what effect that's had on consumer expenditure. Well, it makes sense then that there's been a lot of increase in consumer expenditure as people feel wealthier and more able to purchase things. Another one here, attitude towards debt. It's hard to measure the attitude towards debt, but what you can do is if you click through here, it links us to a BBC News video. It's really good. It talks about personal debt around the world. And what it goes through is that basically in economies where it's easy to get a loan, you're more likely to spend your money. And they go through different places. They go through America. And America, it's and to the UK to some extent, it's pretty easy to get a loan. You just need to have a credit card. If you have a credit card, you've got access to credit and you can spend that money on consumption. In places like Afghanistan, this is nearly 10 years ago now. So this is before the Taliban came back into Afghanistan. But culturally in Afghanistan, it's harder to get money to be lent to you, and it's through family connections, and there will be sort of local informal networks of money to be lent, and probably not as common to spend those loans on a new TV or new consumption levels. So that would be a factor there. Another one here is cultural attitudes. Now this is interesting, and I would recommend watching. Is again from BBC, and they talk about China's consumer spending drive. Again, 10 years ago nearly this. But if you look back, if you look at sort of what's happening with China, you can see their consumer expenditure has been going up over the past 10 years as people in China get richer, as people in China, as Chinese economic policy is more focused on domestic spending. That means that people get more used to spending their money on themselves, and it's going to drive the economy forward through consumer spending. So I would say that these are sort of the main ones that you want to look at when you're looking at the influences on the components of aggregate demand. Now, the next one that's interesting is investment. Now, investment is defined as people, as businesses purchasing new capital equipment for themselves. Okay, so it's not consumers spending the money; it's businesses saying, "I want to buy these new bits of kit." And you can see this is from the ONS. I put this together, but it shows the level of investment. This is in millions. So if that's 450,000 million, that's 450 billion of UK investment. And if we wanted to say, what's the percentage of investment? Let's see if that's there. Does it show? Yeah, here we go. Does it show that? I'm not sure that it does. This shows the growth. It doesn't show us the actual quantities of investment, unfortunately. But let's have a look at this at what's what's happening with investment. Oh yeah, so investment, has been increasing, and then it was decreasing in the financial crisis and recession, increasing a bit. 2016, we saw lower levels of investment, possibly due to Brexit. You might say, sort of flatlined in about 2018, and then during the pandemic, businesses haven't really been keen to make lots of investment because there's been so much business uncertainty. So you can look at through different countries as well. Who's doing the most investment? China does a lot of investment. China's economy is growing, and China is building lots of factories, lots of big cities, lots of places to build more stuff. That all counts for investment. So China is a very much investment-led economy. Other places like Thailand have high levels of investment. The United States, this is at 20%. In the UK, it's something like 17%. So that might be, you link this to productivity actually. Is that investment really is what makes an economy more productive because it allows businesses to, it is businesses investing in their kit, in their technology, which would hopefully make their workers more productive. Um, so let's have a look at some other things. Now, of course, what is going to affect investment? Investment is going to be affected by GDP growth. So if you sort of look at this here, it correlates as well. The reason for this is because remember, GDP growth is income. Income means how much are the businesses going to be able to sell in the future. If the GDP is growing, then we'd like to see investment rising as well. You can see that between these graphs, sort of pre 2008, rising levels of GDP, rising levels of investment, financial crisis and recession, fall in investment, and fall in GDP, and as we're seeing here, fall in GDP through the coronavirus pandemic, and so therefore fall in investment there. Businesses, they don't want to buy new kit if they're afraid that maybe if they're afraid that of the economic future and they're not going to be able to use that kit possibly. Business confidence, like consumer confidence, is something that can be tracked. And I'm not really sure how the scale works, but this is from trading economics, and they say like here's what the Confederation of British Industry says in terms of British confidence, but it tracks pretty well. I mean, it's a bit more volatile than consumer confidence, but you see what happens, right? Is it like yeah? So there's a recession, businesses are not very confident. Spike low in confidence means that there's a spike of low growth in your investment. This is probably Brexit here. So like 2016, big fall in confidence, and that's showing that investment is leveling off. The last ones here, I mean, this goes up and down, but probably lack of confidence through the pandemic. But then maybe we have restrictions lifted, and then they fall. We've actually seen some of the highest levels of business confidence for a while, most recently, and that would correlate. You'd expect hopefully investment's going to rise further in the future as a result of higher business confidence. Let's see. Now this other one here, corporate profits. I think this makes sense, and you can link it through. Let's see if we can see both these graphs on the same screen here. I mean, yes and no, right? Because in theory, the higher the profits that businesses have, the more they'll be able to invest. Um, I mean, profits have been rising all this time. I'm not sure what the scale is. It must be probably millions of pounds, and and I'm not sure if that's nominal or real change in their profit levels. But you can see that when there are periods where profits are sort of leveling off, that's a fall in investment, or when profits are actually falling, like in say the in the coronavirus pandemic, that could be another point at which if you don't have the profits, then you're a bit more worried about your business. You're probably not going to want to buy a lot of new kit that's going to that you may or may not be able to use. So those are the influences on investment. I would say GDP growth, business confidence, corporate profits. Those are going to affect what's happening here. Um, Last two then I think are a bit more straightforward. With government spending, it's hard to describe the influences really, because the influence on government spending are what's happening, what the government wants to do, and what challenges they're facing, and importantly as well, sort of who's in charge of the government, right? So I think this is interesting. These are two interesting graphs. Government spending as a percentage of GDP in the pandemic has gone up. There's no secret about that. But the historical context is interesting here. Is that we used to have a fairly um, low amount of government spending. About 36% in the economy. In the 30s. That rose after the 2008 financial crisis because the government spent a lot of money bailing out failing banks, and and just pumping money into the economy to push out to increase government expenditure, push out the aggregate demand curve, get the economy going again. Um, there was then a period called austerity between 2010 and 2017, 2018, and what that was the conservative and coalition government's policy of actively reducing their spending levels. So like cuts to departments, cuts to funding for different things, and what that meant was that they were trying to, and for political reasons I should expect, is they were trying to lower the government spending as a percentage of GDP. And then you can see here, this is another reason why the amount of of consumers expenditure as a percentage of GDP has fallen is because government expenditure has climbed so massively. So it's like 52% in 2020. That makes sense because the government's been spending so much money. You can look at the total figures here, and I think it correlates pretty well to these. I think these do they stack up on the same, not quite the same axes levels, but for the most part, right? Is that in 2005 between 2005 and 2010 we see a big spike of it, and so therefore it goes up. It levels up. It looks different because GDP growth obviously would have been growing as well. So the economy would have been getting bigger. The government was spending more in nominal terms, but given that the economy must have been growing faster than the government spending was, that would mean that it was coming down as a percentage. But of course, then a big spike here in during the coronavirus pandemic. So not really much to say about the influences on government spending. It's just a matter of knowing that the governments can spend what they want and react to different things as they need to. Net exports is an interesting one. This, as we said, it's the balance. It's the balance of trade. It's what's happening. It's our exports minus our imports. This is from Trading Economics, and I really do like this graph here. I like this because it goes through to show. Oh, sorry, what's happening? Yeah. So I like this because it goes through and if it's in this sort of orangey bit, that means that our exports are not as great as our imports. Our imports are exceeding our exports. If it's in this bit here, that's when our exports are exceeding our imports, and it's a balance between them. It's not an actual level of how much they are. So like if our exports are greater and our imports are greater, it won't make a big difference here. Now so yeah, that's our net exports, and what you can see about selected countries. How do we do? I find this interesting because this shows this baseline level of 0 here. So how do we do in terms of our net trade in goods and services? Yeah, like we run a current account deficit. It's not quite like we don't run a surplus like famously surplus rich countries like China and Germany. Do a lot of exporting, and so therefore they run very very large surpluses, and so their exports are higher than their imports. But we're not quite like the United States. The United States has a lot of imports, and they don't make it up through exporting. So they have a quite a big drag on their net trade in goods and services on their balance of payments. Now, this is the most interesting thing I think, right? Is that balance of trade versus GDP growth. The richer we are in the UK, the more we will tend to buy from abroad. And so therefore, the more we import, that's a drag on AD, the less we're going to have X minus M. And so therefore, it's like, so you can see this dotted line here. That's our growth rate. Growth rate is positive, and you can see that on this this right-hand side here. Growth rate is positive. That means that our balance of trade is probably worsening. Growth rate is negative, like to the recession in 2008. That actually improves our balance of trade. Growth rate is positive. Therefore, we've got these negative balances in our trade. But then look, coronavirus, rate of growth is negative. All of a sudden, it spikes up our balance of trade. All of a sudden, I don't know why, but let's see if we can make a story about this. Is that probably what happened was I should expect our imports, the demand for our imports, went down. Our economic growth was very low, and I guess we didn't have as much money as we did, and so therefore we weren't buying as many imports. Without the imports, it helped to rebalance our net trade, and so therefore presumably now in the early part of 2020 we were exporting more all of a sudden. following the sharp dip in GDP. But look at this. As soon as the GDP climbs again, then we resume having a deficit in our trade because we're rich enough again. As soon as the economy starts growing, that it means it's going to make a deficit in our trade like this. Last one here. Oh yeah, the other thing to know is the exchange rate. The exchange rate in theory should make a difference. I think that we'll see that it doesn't really, but in theory it should make a difference because the stronger the pound is compared to other currencies, this is against the dollar, it's this thing called spiced. Strong pounds make your exports, sorry, strong pounds, sorry, means imports are cheap, exports are dear. And so therefore, like in 2007, when it was like over $2 for the pound, that would actually be a drag on our net exports because strong pound makes our exports less competitive. People aren't going to want to buy our exports when they are expensive in terms of their currency, and so therefore, we won't sell so many exports. We'll buy more imports, and therefore our balance of trade will worsen. This effect is hard to observe, but it's useful to just note that, and it certainly doesn't happen in the short term. And there's some economic reasons for that. But the idea being is that there is this sort of this effect on the effect on net trade in theory of having your currency be strong or weak. So I'll leave it there. I think that what you want to do is this is a good resource here to just make sure that you take some notes on. Make sure you know the AD function, and when you look through, you can say here's what affects things, and this is a good list of things that affect consumer expenditure, a good list of things that affect investment. Not really much to say what affects government spending, but you get the idea. You can look through it and watch this video again to see that. And then net exports, it's basically it's GDP growth that will affect it, and the exchange rate that should affect it. So thank you for watching. I hope you enjoyed the video. If you did, please make sure you give it a like and be sure to follow this channel for more economics related content. Bye.